Hit it.
It's Friday, April 25th, 2025, episode 263. I'm Patrick Serezna.
And I'm Chase Taylor.
Now, Chase, thank you in advance for pinch hitting for Kevin. Now, Kevin's out this week doing his civic responsibilities on jury duty, which I'm pretty sure he accepted immediately once he realized it could get him out of co-hosting with me for several weeks. But not to worry, we've got Chase Taylor stepping in, and let's be honest, you'll all be happy to finally hear someone who actually knows what he's talking about. So my apologies in advance for personally dragging down the quality of the show, but I'll do my best to keep quiet. I'm going to start off here by cracking open this beer. Now, Danny, hop on here. What beer am I drinking today?
So this is the Wonder Crush Crispy Hazy IPA. It's the usual thing that you would expect from an IPA, but it does say, pours light gold with a cloud of creamy head. Do you get creamy head there, Pat? Or are you getting that flavor?
All right. Chase, I almost asked you to have a beer ready, but we are literally on the opposite sides of the world. Like you're on the West Coast. It's 8 a.m. for you. It's 4 p.m., which is a very acceptable time to drink beer out here in Portugal. But it's 8 a.m. So maybe, I don't know if you want to have an eye opener or something like that to get you started. But
I have the coffee with some I think cinnamon coffee cake flavored creamer. So I don't know if it has a creamy head either, but it's definitely delicious.
All right, there you go. All right. So listen, let me give quickly the side effects and then we can start shooting the shit here about the charts. So nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much market huddle may include earnings anxiety disorder, whipsaw vertigo, and liquidity lockjaw. All right. These sound nasty. I haven't had any of those yet, but we'll see. All right, Chase. So listen, we're going to stay with the tradition of covering the top three things to watch. And so I prepared the top three things that I think are really important for the next 2 weeks. So number three is whether or not we've seen the top in gold. And well, let's just start off with your opinion. What's your thoughts here about how gold's been trading and what's next?
Yeah. My view, I mean, we've been bullish for a long time, like I think anyone should have been, and kind of it's obvious on the chart. But thankfully, last week started to get concerned. And honestly, the biggest reason is just because literally everybody became bullish. Like I couldn't find a single soul that didn't like gold and wasn't talking about it. All the positioning, sentiment, everything got super stretched. So
you know what? The interesting part, just to, I didn't mean to interrupt you, but I always have a important rule. When I have three or more, either family members or friends that don't trade, text or ask me whether they should buy it, I immediately consider that to be like, that old saying of when the taxi driver or the shoe shiner boy is giving you stock tips that you got to be worried. So I use my family as the contrarian indicator on that stuff there. But anyway, so my phone was ringing. It was crazy. Okay, but anyway, go on with your point.
It really is how you know. And I saw some people capture very well on Twitter, like showing kind of the crazy sentiment stuff that started happening. And what I find interesting about this stuff is so often it will be like a steady small drip. And then all of a sudden you'll just get a huge cluster of it's the thing everyone's talking about. So like in the media, the headlines went nuts. If you look at like Google search trend for GLD, like just went crazy high, and it all just happened like within a week. So they kind of gave you that warning. So, I mean, it's going to be a buy on dip. I think like it's in a structural, secular bull market. Just the question becomes how big is that dip? And I think we have a decent amount of froth to burn off, but it'll be fine medium, long term, but short term, I am still worried about it.
So to me, what I'm watching here, Chase, so here, I'll put up the chart. The one thing that I'm watching here is that typically, like we saw that pullback even during the heat of the tariff tantrum back over here, It was a quick Fibonacci retrace back to the 50-day moving average, and immediately got bought on dip within 3 days, right? And so the Fibonacci retracement zone of this pullback lies in the 3,200 to 3,300 kind of zone, right in here, and the 50-day moving average is just trailing right behind there. And so, to me, if we have one of these 3 to 5 day pullbacks that stays above 3,200, then this could be one of those very short-term pullbacks that then actually just resumes on the upside and breaks 52-week highs and goes. In my mind, if we break below 3,200 and the selling's taking 5 days, 6 days, 7 days, and it's just distributing, then I'm going to be in the camp that this is more of a intermediate top, where we might end up spending 2 or even 3 months in some sort of a backfilling consolidation. Could be 3,000 on the downside or lower, but it's just going to be more of a muddle. The example I often give is just like what happened back here during the August through November run. You had this really bullish advance in gold, and then it did this horizontal triangle pattern for 3 months, right? We just literally spent 3 months trading sideways, including a pullback at the time that was about close to $300, $250 on the downside. And so we're trying to kind of puzzle solve whether or not this is one of these kind of more, longer term kind of consolidations, or whether this is just a short term pause before going through another stupid parabolic rip to the upside. Any comment on that?
I think that's a good way to look at it. I think even taking the shot there when you kind of test the 50 days, probably a good thing. Tight stop. If it keeps going, they're like, that's how you know, okay, well, maybe we are going to like 2,800, like on a worse move, as stretched as we are. So one of the things for me on a move like that is to keep an eye on that like sentiment positioning stuff, because sometimes you'll pull back 5% on something that you think's too hot, but that's enough to like wash a lot of people out, and you can feel better about getting back in. And then sometimes you have that 5% move, and it feels like nobody cared, everyone's still on board, and that's usually when you have to keep going. So kind of keeping an eye on some of that stuff on that first attempt is going to be key. But I think your way of looking at it's like a good proxy to set up to have a make or break level, and then if it keeps going, we're probably like you say, a 2-3 month thing.
Now, before we go to number 2, let's just briefly touch on gold miners, because the one thing I just wanted to highlight using the GDX is that the pattern setup is almost the same. The Fibonacci retracement zones in this like $46 area, and you have the 50-day moving average creeping up into the $45, $46 area. Odds are that if the gold is testing that fib zone at 3,200 or close to its 50-day, so will the GDX. And likely they're going to correlate. Either they're both going to bottom and rip, or they're both going to bust through. Do you have a different view on that, or does that sound about right?
No, I tend to agree. I think the miners deserve to maybe be flat in a or down 5% in like a down 10% gold market. I think they deserve that on their fundamentals, but I also don't think we'll get that.
Yeah. All right. So let's move on. Number 2. On our top 3 things to watch are earnings. But it's not just earnings. I mean, of course, the broader earnings, and I'd like to get your opinion on that. But we just had Tesla. We just had Google come out. And both of them have initially positively reacted. We'll put up the chart here in a moment. But within literally 24 hours from the Wednesday close to the Thursday close on the 30th and to the 1st, we have 4 of the Mag 7s coming up, right? You have everything from Amazon, Apple, Microsoft, and Meta, the 2 A's and the 2 M's that are going to come out. And I think that they are going to be a huge player in or a factor in determining the sentiment of where we are going to be trading for the next few weeks. And one of the things that why I believe that that's the case, if I pull up the chart here, I have the Mag 7 ETF here. And the Mag 7s were where the bloodbath occurred. The peak to trough was a 34% decline in a span of 110 days. It was just a vicious decline, wiping out 1/3 of their value. And their bounce up until now has been really pathetic relative to the magnitude of the rally that we've seen in the S&P. So if this incredibly oversold and negative sentiment is neutralized by earnings that at least on the surface are, oh shit, maybe things are not as bad as everyone's making it out to be. Maybe if the Mag 7s are have a multi-week retracement the other way, that could drive the whole stock market to have a few weeks of kind of positive trending price action. At the same time, it could also be what opens the floodgate for another shellacking, which is not the scenario I favor, but I think it's that important to watch. What are your thoughts on all these earnings?
Yeah, I mean, I definitely think it's gonna be a big deal. I think maybe earnings revisions and earnings expectations, kind of more forward looking, are starting to maybe matter a little bit more than these results, as those forward those quarter, the next 2 quarters become huge. We're seeing all kinds of companies either withdraw guidance or bring it down. But I will say, like, I think a lot of these Mag 7 companies can start to outperform because it's they don't have to import a bunch of stuff. They have very sticky demand on a lot of what they do. So I wouldn't be surprised if some of these Mag 7 earnings are actually pretty good. Maybe not Apple, but some of the other ones. And it's somewhat notable to me. Like, if you look at, say, like Google, Amazon, Meta, and you just kind of look at their forward PEs, they're actually at the bottom of the range of the last like 15, 20 years. Like, so versus their own histories, they've a lot of those have gotten cheap. Now, Apple and especially Tesla, like, are still kind of insane on a valuation standpoint. But and that was a fun one with Tesla because, I mean, it was an atrocious quarter. Their guidance is bad, and now, I mean, it's up like, I don't know, 20-something% probably since. So
Yeah,
that's
like
always fun.
but what's interesting from a technical perspective on Tesla, and well, first of all, it's the first attempt to close above its 50-day moving average since January. So it's been a very ugly on a relative basis to the Mag 7s. I mean, this was a 55% wipeout to the downside, while the rest of the Mag 7s were in the 30% ranges. And so it was a very ugly crash. And clearly, we've got a basing formation. I don't know whether we want a cookie cutter or a double bottom or some other term on this, but it is definitely some sort of a base. And the big question is, will it actually be able to break out of this trade range? Would you speculate on the upside here on Tesla?
No, in fact, I would like to go the other way when it gets to the top of that range. I
And
mean,
fade it?
yeah. So like not this past quarter we got, but the one before that, they, we're talking about, oh, like, it's fine because we're going to be growing like 30% here in no time. We're going to be back to growth this year. And then this quarter it comes out and they're like, yeah, we're like just kidding about that growth stuff, essentially. And the current numbers, the backward looking numbers are, I mean, abysmal. So, and it still trades at, and like you said, I mean, it got cut in half, and you're still trading at 90 times forward earnings. So, like, and it's a car company. Like, now, a lot of that stuff's been true for a long time, and it still has amazing rallies. So yeah, if it breaks out of that, like, why not buy some calls on it, or be long or whatever. I think that's makes sense. And hey, we got this wide breadth thrust yesterday, so maybe the whole market's going to rip for a month or two. Who knows?
Right. Is there any particular charts on any of the Mag 7s that you wanted to touch on or comment on, or are you just looking at them all broadly?
Looking at them broadly, but like, I honestly kind of like, not necessarily the chart yet, but kind of like Amazon, Meta, and Google all.
All right,
And
let's look at them.
it's not usually me to love them, but here we are.
Well, listen, they're cheap. When any asset gets cheap enough, you got to give it a shot. We're traders, right? So what's interesting is we can take a nice thick crayon line and draw this descending trend line down along here, that 50 days creeping in. It did a key bottom retest that's some people would like to call a double bottom. But the question is obviously which direction does it break on its earnings? And that's obviously going to be the real tell on this. But certainly incredibly oversold and due for some sort of a retracement. A fib retracement back to $200 to $210 would be par for the course in terms of a typical reaction. But the question then becomes, can it recover all the way? And I'm a seller on a full recovery. To me, this is a tactical opportunity. But the question is it worth an earnings risk? Like, do you play the earnings pin hand grenade game of like, are you the bag holder holding one of these things when they miss? At least clearly everyone on Google scored one with a nice gap higher here on the earnings that happened. But it's going to be very interesting as we go. So you were talking Meta. I guess it's the same chart pretty much, right?
A lot of these, a lot of this stuff's the same. And honestly, a lot of it even just looks like the S&P, which I guess isn't surprising, but
yeah.
Yeah. And for me, I'm never a big like, oh, here comes earnings. Let me make a bet. Like I know I have less than zero edge on earnings. So that's not for me.
Yeah, I'm with you, buddy. I know I don't like to bet on earnings, and if I do, it's always with something like a bull call spread. So you're hedging out the implied premiums that are jumped up, and allows you to have less capital at risk in those environments. So let's just touch on number three, the top three things to watch, and the number one, which is the U.S. jobs numbers. And, obviously we've seen a scenario where a lot of recession fears are coming into the market using something like the poly markets, betting markets, as to what is the odds the U.S. is in a recession this year is like a 55% probability. So therefore watching whether these kind of data points are showing those clues, like obviously PMIs, ISMs are all ones that a lot of people are watching, but there's the infamous SOM rule, which, if we get that spike in unemployment, usually it's a pretty good confirmation that there's going to be some sort of an economic recession. The interesting thing, though, to me about jobs numbers is that rarely are they a leading indicator. Usually by the time the jobs numbers are printing negative, you're already in a recession. And this is why, like, I'm asking the question, is this the month that we're going to get the kind of crappy jobs number? Or is this still going to be one of those normal months and that crappy jobs numbers coming this summer or something like that? What's your tilt?
Yeah, I lean more towards the latter. Like I don't think it hits here. Now it might start to be felt, but I don't think we have like a negative print here or something like that. I think Bloomberg has it at 125,000 and the Kalshi is at 158. So it's interesting to have the betting market higher than economists right now. And like almost every month, we have the unemployment rate staying the same. The one thing I will say, I could see we're people are expecting 4.2% for unemployment. I would not be shocked if that does take up another tenth there to 4.3. And I wouldn't be surprised if it was like a 90,000, something like that. A disappointment. For me, I'll be watching as I do every month really closely, keeping a close eye on construction jobs,
right?
Because I think that's one of the keystones here. But yeah, I think all these feedback loops like really start to hammer us more in the summer because if you think about the last month, we had a lot of tariff front running, which created a lot of activity, which probably helps keep employment higher. We had low jobless claims, so nothing I'm looking at suggests, oh, this is the one. But if these tariffs stay in place anywhere near, the worst levels, yeah, by summer, I think you start seeing negative prints.
There you go. I could I agree with that in principle. Like I think though that if this was a really bad jobs number, this could be a market freakout event because nobody is expecting it. And even though it is like, well, I'll agree with you, is I think it's a low probability that it's this month. But if it happens to be a bad print, the market's not ready for it and it's not pricing it in. One of the things that I've been pretty adamant about, which was the first leg of this decline was all driven by tariff tantrums. No one was prepared for things to escalate the way they did with Trump and the tariffs. And now everyone is hanging on Trump's every word. But while I think that headlines around tariffs could create these 100 S&P point swings up and down on a reactionary basis, I don't think the next leg down in the market is going to be driven by tariffs. It's going to be driven by fundamentals, which is when there's a realization we're in a bear market and that there's a recession and that corporate earnings are going to contract. That's the period where I think that we could have another key drop in the markets, and not about these tariffs. And this is why things like these jobs numbers and things like how earnings come in are going to be pivotal for determining whether this is a story now or a story this summer. What's your thoughts on that?
Yeah, I think it's a great point, and I think the analogy I used yesterday on my show was the market's now looking through a soda straw at only tariff headlines. So like everything else, it's just forgotten about. It's even forgotten about tariffs on what they really mean, because it's just worried about the headline hockey of the day. Because we got to the point where like we're ripping higher because tariffs on our largest trading partner are only going to be 50-60%. Like if I told all these people buying the market here because on that relief, hey, going into the year, we're going to put like 60% tariffs on China, they'd be like, sell everything, like get me out of the market, because that's crazy. But now that we're coming from 200 or whatever to 50, 60, people are like, oh, whew, that was a close call. Thank God it's only 60%, you know. But if you really think about it, like that's awful for the economy. So we still do get your fundamental, you know, like comeuppance that shows up. But that delay from soft data to hard data, and that delay from, you know, all of us front running with a bunch of activity on tariffs to actually having to wait for the other side of that, where all that activity dries up, that creates a nice little environment that's easy to get into that trap on. So I think that's pretty much exactly what we're looking at.
All right, so let's talk some charts, buddy. I mean, let's go and lightning round through a whole array of different things. We got to start with just the S&P 500 and these indices. And the first thing I want to highlight is, so we obviously had a market decline, a crash that was like one of these 47-day drops that was 22%. The typical, in my mind, the typical time you see these things, it's very reminiscent to me of something like January of 2008, where the first started with a drop, the market stopped, consolidated, and the next leg, like the short-term bear market rally and period of consolidation, was 4 months. The market basically stayed in a consolidation all the way till May of 2008 before the data started getting really bad and the market started another leg down. And so the big question for me is that am I too obsessed with this being a bear market and that there's something in there, like, or do you think that this could be it and there could be just the beginning of the next bull phase? What's your overall feeling as to where we are in this market?
Yeah, my feeling is bear market rally, but I have to preface that by saying, me and most of the people I know, every time we go down more than 10%, when we get a rally, everyone I know is calling it a bear market rally. Like almost never does anyone I know go, no, like it's over. You know what I mean? But just when I do the analysis on the drag that the tariffs are likely to cause and all the uncertainty, it suggests to me like, no, like you can't just go rip to new highs. Even if you take the tariffs like pretty much off, like there's still some damage there. But to use that analog you just used, like, could I see bouncing between 5,000 and 6,000 for 4 months? Or yeah, absolutely. Like that's not crazy to me. Waiting for that lag and the hard data to go, you know, to like actually raise the red flag in the summer or whatever, like could totally see that. But I'm really trying to remain open-minded that, hey, for all we know, the policy pivot's big enough. Maybe we do have a mild recession and the market's just happy to look through it and just go higher anyway. Like I'm open to all of that. And maybe, you know, hey, maybe this dollar weakness is enough to actually boost some of those Mag 7 earnings enough to kind of carry us through. So I'm trying to be as flexible as I can. my base case though, yeah, but is bear market rally. Maybe we even go up to 6,000 to like really trap everybody. But yeah, that's the way I look at it.
Well, you know, I mean, a rally to 6,000 is essentially almost a double top retest, right? Like that's getting right up into that territory. But what I would need to see in order for me to drink that Kool-Aid that we're going up there would have to be a very positive reaction to these Mag 7 earnings, because if they're not ripping, we ain't going to 6,000. In fact, we're not even going to 57 or 5,800 without the Mag 7s ripping. Like, to me, they're that big and they're that important and they're that oversold that in my mind, they need to be sort of where the fuel for these indices are, for there to be those kind of deeper retracements. The thing that's the reason why we could see a 5,800 or higher, like you're suggesting, is because the Mag 7s have more to go. Like, I'll give you an example. We are on the S&P already above the 50% retracement. In other words, we had a 1,300 S&P point drop, and we're almost 700 points off of the low already. When you're looking at to any Mag 7, I'll just use the Mag 7 index, we're nowhere near a 50% retracement on the Mag 7s. And so the Mag 7s were laggards. They were never really driving this S&P move. So suddenly the Mag 7s go ripping into the fib zones. The S&P 500 has lots of room to tack on 300-400 S&P points to the upside in that period. But that would be an interesting thing where the S&P double tops, but the Mag 7s all fail at fib retracement zones. That would be a kind of interesting setup for another round of selling that could come at some point there. Any comment on that?
Yeah, I think that's very possible. Even going to 61.8. You know, if you think about it, like dealers have been stuck in negative gamma almost the entire last 2 months. So if they can flip into positive, get the VIX from the 20s back into the teens, get like all, I mean, none of the systematic strategies own almost anything anymore. Yeah. So like, if you can calm the market down enough to where systematic can start nibbling again, then that's where you can get into this awkward thing where you're just up, 0.4 every day, and everyone's just like, how's this possible? And it's like, well, because all the machines that have rules are buying. Like, so I think that kind of stuff could happen. You could have that kind of 61.8% retrace, even if it makes no sense when you're following the data and the news. But then that's where the market is. That's where the hedging gets like good again, because when we fell off a cliff, all your hedges you have to monetize, and you're looking around like, well, I'm not putting any of this stuff back on. So in a way, like I hope we do that so that I can hedge more responsibly than now.
Well, the interesting part is if you change your frame to the kind of thesis that the market is always seeking the pain trade, what could fuck over the maximum amount of investors, and you use that as a base case for thing, well, then a market here that starts ripping with too many people on the sidelines will just make the FOMO kick in, like the bus has left the station and I'm not on the bus. And that could just spur the very essence of what a bear market rally is to sucker everyone back in. And so it's almost like this thing would need to last long enough and go far enough for everyone to suddenly stop being bearish just because there's too much pain in being on the sidelines while watching all this money being made. And so, for us to, if we can get past the earnings and the jobs numbers without it being an event, there's no reason why we can't be in the middle of May and still the markets are in a positive trend.
Yeah, exactly. I mean, if we got to July and it's 5,900, I just wouldn't be surprised. And depending on what's actually happening on the ground, like I think that would be a great spot to get bearish again. But I just wouldn't be that surprised. And you just painted the perfect picture for why.
Yeah. Well, you know what? To me, I don't know about July, but I definitely think that a May and June kind of period where the market is gravitating higher is entirely possible. But what's interesting, though, I want to quickly talk about the Russell and just how weak the small caps have continued to be relative to the S&P index. And for me, I would think that if we're in a period where the kind of really smart money sees green shoots, and like that the economy is turning and everything is coming and they want to go long, you would think that there would be much stronger flows in the small caps, which tend to outperform in that kind of period. Do you view the fact that the Russell continues to lag behind this way as a red flag?
I mean, I just view the Russell as basically trash at all times. Like I just can't do it, man. Like so much of them have tons of debt. So much of them, like are going to depend on trade for a lot of what they do. The weak dollar is manna for heaven for a lot of the Mag 7 companies, not so much for some of these Russell 2000 companies. Like it's just not for me. One of my favorite things to fade was when everyone bought the Russell on calling it the Trump trade, and it's like, yeah, no, that's not going to work out. Like that was one of the dumbest moves I've seen in the last year. It was when everyone bought that on the election. But so for me, no. Like someday,
don't hold anything
it'll
back.
Have a run.
Just tell me what you really think.
Yep. I'm happy to. To me, it was clear, like the European defense stuff, that was stuff like that made sense, not the Russell.
All right. Well, let's actually talk about some of these international indices while we're on these, because the European indice, like first of all, before the crash, it was a beautiful trend. It was ripping to the upside, holding above all the moving averages. The S&P and the Mag 7s were dragging their heels and rolling over. It looked like this was the safe haven trade. And then the rug got pulled out in the most epic way. It was like a 5-day drop that had that thing go from like peak to trough down like 20%. It was like just ridiculous, that drop. So now, when that happened, look at the velocity of this rally. There's nothing like this evident in the Mag 7s. There's nothing like this evident in the Russell. Exactly. Like you have an immediate buy on dip that happened, and you're already back to the 50-day, back to the 61.8 retracement, and it's back up in generally outperforming. Do you still favor the European markets here?
Yes, and you have three of my favorites down below, so I'm gonna have you go look at those, and actually, yeah. I'm gonna stretch your time horizon to a monthly. So EWP, EWI, and GREC, you have all in a row. So that's Spain, Italy, and Greece.
All right.
So to me, pigs are, and you should appreciate this for where you're at in the world. Yeah. To me, pigs are flying. So Portugal, Italy, Spain, Greece, and Spain. Like that's obviously Portugal doesn't have an ETF anymore, but these are my favorite markets. Like
yeah,
they're getting a disproportionate amount of European fiscal, and it's been wonderful for them. So a lot of these are hitting new highs, like for the decade. Like a lot of Western Europe stuff is in general. Like these are.
So you want me to look so here's a monthly chart of, let's say, Greece.
Yeah,
like this thing just
single favorite. Yeah, I love Greece.
I'm spending the summer in Greece, but I don't own Greece right now. But I'll check it out. I'll be boots on the ground. I'll report back how the conditions are there.
Real quick. Yeah, like Austria hitting like major highs. You have Germany hitting major highs. Yeah. I mean, Poland's up like 40% year to date, and it's April. Like this has been the place to be this year. Like I like Latin America and some stuff too, but I just love Europe, especially the forgotten pigs.
You know what? They are, but and what's interesting is, like, okay, let's use Spain as an example, right? Spain did a perfect 61.8 retrace during the crash, and then goes ripping to an all-time new high within 2 weeks.
Yep.
Like this is as classic of a buy on dip as you get. The traders use that the Trump tariff kind of panic to freaking do one of the most epic buy on dips, and this thing is autopiloting to $42 to $45 on the upside here. Like it's not quitting. Obviously, I don't like to buy rips; I buy dips. So I need to see these things pause here a little bit. But you're absolutely right. These European markets are buzzing. The other interesting one I wanted to talk about was also the Nikkei. Like, so what's interesting was that crash in the Nikkei back in the summer from the yen carry trade unwind got us down to this 31,000 level. And I thought was like, shit, we're not going to see a crash like that
I know.
again. And then here we are, like literally 6 months later, and then the thing goes and drops all the way back down in this straight line drop all the way back there. Similarly, to almost all the global equity markets that are developed markets that are correlating this way, we're all back to like a 50% retracement on everything, like back to the 50-day moving averages on this. What's your bias here on Japan? Obviously, you love Europe, but you think Japan here is going to kind of grind a little bit more?
Yes, I struggle trading Japan short term. Like, it's been brutal. I don't care if you're a bullish or bearish Japan this year. It's just been tough to trade. But I still think, and this is going to get very fundamental for a second, very macro, but
Yeah.
I still think you have the possibility that their inflation runs hot enough to where they have to raise rates high enough that creates enough interest income within the economy that further pushes inflation higher, and then you get that feedback loop and that will suck in a lot of capital, especially their own capital that's overseas. So in that scenario, you could have both the yen and their equity market like really do a lot to the upside. But that is a very long-term view, and it's not necessarily high probability. So it's kind of impossible to trade other than a small set and forget position. Short term, like I like it, but I know how often it whipsaws me. So tough to trade.
My kind of position on Japan is that up until this moment, it has pretty strongly correlated with U.S. equity, and I think it's fair to approach it as a starting base case that it's likely to kind of track and correlate with the kind of global developed markets and the U.S. equity markets. And I don't think that it will march to the beat of its own drum. While you can see Spain and Greece doing it, odds Japan does it, not so much on that front.
I tend to agree that, like, because everything I just laid out is more of like a 3 years out type of scenario. So it's just tough short term.
Yeah. No, what's interesting, the other markets that I was watching, you could tell me this is the Sensex on India. India went through a pretty significant correction for close to 6 months, actually more like 9 months. And it was correcting long before the US markets or any other. And it did about a 17% market correction altogether. But you saw a scenario where during that tariff thing, it took a little bit of a dump to a temporary lower low, pulled in the turtle head formation along the bottom there. But it's back above the 50-day. It's beat this descending trend line. And the question here is the sell cycle in India over? And are we potentially seeing the Indian market turning around and potentially doing something bullish? What are your thoughts here?
I think yes. And I've been kind of bearish India for a couple of years. Just wildly expensive compared to almost anything in the world, not just overseas. But I mean, that was a pretty big correction. And, if you look at kind of macro data and stuff's gotten better. Now, obviously, what's going on with Pakistan, all of a sudden, like, you got to keep an eye on that because it could impact markets. But when I look at not only its chart, but then if you plot its chart against a whole bunch of different other countries, like, it looks good. So yeah. I like it. I like India here. Maybe a relatively tight stop, but I do like India here.
The other market that was really interesting is the basing formation and breakout on the Mexico markets. And obviously, Mexico turned just after its elections, things got kind of messy there for a short-term period, and it was settling off again through all of 2024 when the rest of the global markets were doing half decent. But what's interesting to me is it never really sold off during the global tariff tantrum. And those 3 days that it kind of reacted, just like your Greece trade and shit, it immediately recovered. And it actually is now breaking out of a 4 or 5 month trade range and starting to trend. What are your thoughts here on whether this is a turn point in the Mexican markets?
Yeah, I mean, it does look like a turning point, and we started off going very, very hard after them on trade and stuff, and it seems like that has cooled down a good bit lately. It's sort of obvious if you really think about it that a lot of this trade stuff, all roads kind of lead to Mexico for producing a lot of this stuff. Since we all make the jokes like no one in America is trying to like put together iPhones, but hey, maybe some people in Mexico will. So I think it can make sense. I worry about the policy volatility from both sides of the border, honestly, but I mean, I cannot argue with the chart. I cannot argue with the value. They have policy space to cut rates a lot more if they need to. So I think there's plenty to like, and I think Claudia Scheinbaum's done a very good job to date in her term. So I like it here.
Last emerging market that I want to touch on is Argentina, and it seems like a lagging chart of Greece, where like it basically had a rip. It kind of dropped on that tariff tantrum and immediately recovered back to the high. And while some of these kind of European markets that you highlighted that broke to new highs, we haven't seen a breakout in new highs here to Argentina. But in your mind, is this still a primary bull trend and room for this thing to keep going?
So I would say don't love Argentina. If you actually look at a 3-year look back for every country ETF, Argentina is the winner by like
a long margin.
Yeah, they're crushing every country on earth. And I think Greece is number 2 or number 3. So your comparison's apt because they're kind of the 2 best places to have been. They did just kind of float the currency, and they just got a ton of money from the IMF. Clearly, the U.S. administration is very cool with them. I think their policy changes are off to a wonderful start. I think it's really working great. So there's a lot to like. But if you kind of look at the average PE of everything in that ETF, it's mostly ADRs that Americans like. So it's not as cheap anymore as it used to be on those ADRs. So that's why I like it, don't love it. I think the economy has tons of room to improve and get better moving forward. So there's plenty to like, but man, it's gone a long way in the last 3 years. So it makes it a little tougher to love.
Yeah. All right. Enough about equities. Let's move on. I want to just do a quick kind of lightning round on some of these currencies and bonds, and then I want to go deeper into commodities. So just very quickly, obviously, the U.S. dollar had for what was essentially a 2-month drop, almost 3-month drop. It moved 11%, 12 Dixie points on the downside in a pretty distinct dollar puke here. So the question here is the short-term dollar low coming in here, even though there might be a bigger picture dollar bear market forming, but is this too fast, too quickly? Are we going to bang out a short-term low, or is this thing just going to keep puking?
Yeah, I kind of lean with the first. Like I think it's too much, too fast. You can have a short-term bottom, maybe get back up to 102, 103 or whatever. And then but at that point, maybe even 104. That's where I would be thinking about pressing against it again. Yeah, I mean, that was pretty much, that was a historic move. Like that was a big deal. We had some of the worst weeks and months in the last like 30 years. So that was a big deal.
Yeah.
And my assumption is the capital outflow stuff can slow down from here.
There you go. I'm in the camp too. I think that, and one of the interesting ones that kind of gives me the clue is looking at the U.S. dollar yen. And when you observe, the U.S. dollar yen has now traded to where it banged out its previous lows in the last 2 years. And it's not that low has to hold. Kevin would be on here saying there's no such thing as a triple bottom. But to me, it at least reacting off of this low after such an oversold drop, us getting back to 145 to 148 on the upside of the U.S. dollar yen would be, I think, a typical reaction. I feel like almost like if the yen was going to have another major bull breakout, it's probably a second half of the year story. And it's
Yep.
still entirely possible that that will be the bigger picture trend. But I think that this is too far too quickly, and things are likely to settle in here.
Yeah, I agree. And there's two reasons that makes a lot of sense. One, it sounds like we're not talking about currency stuff in our trade negotiations with them, which I think everyone expected. That offers the yen, a good reason to go back down. And then on top of that, we had really hot inflation come out of Japan, and we're still down on the yen. That says a lot. So I tend to agree.
Yeah, yeah. So let's touch on the asset that shall not be named, Bitcoin. The Now, Bitcoin. What's interesting to me about this chart is that while it's been in a downtrend for 3 months, or 2 3 months, and stayed below the 50-day moving average, it never really got ugly. Well, I mean, okay, maybe on a percentage basis, but when you look at the natural implied ranges that and volatility that's normally associated with Bitcoin, the fact that the whole risk asset complex was getting its face ripped off and Bitcoin was dropping 10% and shit, to me, that's a win for Bitcoin investors. Like the fact that this thing dug in there. And after now 2+ months of trading below its 50-day moving average, that's a pretty decisive breakout back above its 50-day moving average. What are your thoughts here on the crypto space?
Yeah, I agree, and I think if you look at it versus gold, it especially looks good all of a sudden, and that's an important view. Like I mentioned, like thankfully was able to get out of the way of some of this gold ugliness. Not didn't pull back to zero, but trimmed hard. And what made sense for me to do was to take all those winnings from gold and go plow them right back into Bitcoin because you were kind of testing support on the
Yeah.
ratio of those two. But yeah, like I thought we were going to go low 70s into the 60s. I was hoping we would. I sold, thankfully, up over 100 because it was just like gold just got. Everyone loved it. Everyone was long. It was just so frothy. So I'm like, all right, get me out. And
Yeah.
then later in a bunch of buy orders, but most of that clustered buy orders was like between 65 and 75. So I was actually really frustrated that I didn't get filled on a lot. But then when we started to break out, it's like, all right, well, you got to get back in there, even if it's not in the 60s the way you wanted to. So I'm very bullish, at least short term. It's kind of underperformed its liquidity proxies lately. So I expect it to do some catch up here, like it's already started.
Yeah.
It's
This
especially useful to hide from the gold pullback.
Yeah. This 95 to 96,000 level is the 61.8 retrace area of this. And to me, that's the real tell. Will Bitcoin be able to clear this hurdle? And that, because usually an asset that clears that kind of a fib will means that there's genuine bullish flows. And so
Right.
this is to me a real kind of line in the sand. Will Bitcoin break it, or will it fail at this level? And we'll know within a week or two whether it does. But that's sort of where, if this thing's going to be bullish, it should be able to clear that to head to 100,000 easily. And so
Yeah.
let's see how it plays out.
And in this case, that retrace, that level is exactly at the kind of the waterfall level whenever you kind of collapse in February. So that it's
Yeah.
like a double nasty level.
Yeah.
I think it'll take some chewing to get through it.
There you go. So let's talk bonds. Me and Kevin are always contentious about this because obviously Kevin is like the mega bear in bonds. And I don't hate the bear thesis. I'm just much more of a trader on this stuff. And he's more of a hater. And so the interesting part to me was obviously this basis trade uh, killed the long bond. So let's just start with the long bond here, where it just ate. This is the 30-year Treasury futures, and it just ate it, like complete wipeout of what was a constructive chart, looking like it was progressing higher in a period that typically bonds should do well when it's risk off. Bonds were doing okay, and then just got their feet kicked out from underneath it. What's interesting is that while the long bond ate it, it was just a little bit of noise on the short dated bonds, which basically has really kicked in the steepener. right? And so here's the 2s, 10s, but it really kind of spiked this thing. I mean, we were in deep negative inversion. I'm going to put this on a weekly basis, and we were down under 1%, negative 1% in terms of the 2s, 10s curve. We're now like in clear territory, as this is a full-on steepening. What's your thoughts here on two things? One, how does a long bond play out? And two, if we do have continued steepening, is this the short bonds? Like, is that like there's going to be policy error by the Fed and the market's going to start pricing in more rate cuts, and we're going to see the short end be where all the action is? Or is this going to be a bear steepener where the long bond just eats it? And is the steepening the continued trend? Like, what's your thoughts here on interest rates?
Yeah, so I remember like 6 months ago, everyone was all in on the steepener, and it made me nervous. Now I'm all in on the steepener too. So I keep it really simple with this. I know if the economy gets bad, the 2 years gonna have my back. I don't know if duration will have my back, because if we go into recession, we might go from 6-7% debt or GDP deficit to maybe 10, 11, 12. That's a tough environment when foreigners are backing away some, when the Fed's not buying them at the moment, when you have to issue that much more of it. Like, and for all those reasons, I don't know if it will have my back. And you talked about, obviously the basis trade played a significant role in that, in some of that washout we've had in the last 2-3 weeks. But I will say some of those moves correlated to some headlines people are sleeping on. Like, President Trump came out and talked about $1 trillion Pentagon budget. It didn't seem to like that. The tax cut, a lot of the headlines around tax cuts, it hasn't appreciated, where it looks like, oh, they might be unfunded tax cuts. So I would say to listeners, don't sleep on fiscal in the U.S. Suddenly not being that helpful. Like, Doge was supposed to save $1 trillion or $2 trillion, and now it's like, oh, maybe 200 billion if we're lucky. So that fiscal side might pressure duration as well. So fiscal profligacy and a real growth slowdown may be a problem. I'm totally open to a tactical, nice rally in the long end on like imminent recession when everyone didn't see it coming. But that may be a thing where it rallies for a month or two instead of a year or two, like it used to in a recession, because all of a sudden it looks over and it's like, I'm sorry, what, 11% deficit? No, thank you. So that's my thought. But I love the 2 year. That's my biggest position in every strategy and every portfolio I have.
Love it. I'm actually playing it with longer dated SOFR futures. So like, here's your, I was looking at this, this is the 3-month SOFR futures chart out to December 2026. So we're going out all the way to the end of next year. And right now it's pricing in more or less 3% interest rate, just above 3% on this front. And I don't think that this is at all pricing in the chance that the Fed will have to be far more dovish than everyone thinks. And
exactly.
And so this is pretty much a play on the 2 year. Like, with this guy, and so I'm looking at it here, and this my idea is we could go 97.50, 98, which is approaching 2.5% interest rates. Is that out of reach, you think that that's a realistic target, or are you even that much more bullish?
Yeah. So I'm in December 27 actually, because I want to say it even has less cuts priced in, or it's close enough to the same. It's to me like it is not impossible to go back to zero. Now, do I find it likely? No. Do I think more like one or two is more likely even in a recession, because inflation is a problem? Yeah, that's probably the case. But there are some scenarios where you could get the feedback loops that just take you all the way to zero. And that is, not even almost priced. So you have like 3.2%, I think it is, at the end of 26 going into 27. And that does not even almost take into account a real recession. So to me, that this thing's mispriced and has been for a while. You go back and look at what you could have got it at in January. Like that's completely insane.
Yeah. No, it is insane. I've loved that trade all the way back to January. One of my temptations is to go into the options market and do split strike synthetics, where you're selling the put options to buy call options on the upside, and obviously at a different strikes, but just this idea: which way is the tail risk? Is the tail risk that interest rates will go much lower, or is the tail risk that they're going to have to hike rates significantly and interest rates are going to go way higher? To me, the asymmetry is only skewed one way. I mean, maybe if the Fed has to keep things tight, it's not going much higher. It might go, but if I'm talking worst case, which is not even like what I think will happen. But to me, the idea that things get really bad and the recession could get worse, while it's not a certainty, it's not a guarantee. I don't want to talk like that, but
Sure.
though that's a real risk. That's something that can happen. If it does, it pays big. Like, yeah.
So I have I think it's 98.75 calls on December 27th.
Okay.
They're basically free. I mean,
you're being a rock star, buddy.
and to your point, like, you can fund some of that by selling the other way, because if you really think about it, if inflation were to get so high that the Fed should probably raise interest rates, at that point, the trade war has to die. Like, if there's one thing I am convinced Donald Trump's not willing to sit through, it's a bunch of inflation that alienates the entire voting base to fund, a trade war that polls terribly. No one wants to do it if you actually look at the polls. So, like, the asymmetry for the political standpoint is so big. And this is where I would assume the Fed goes and it's like, look, you got 3 months to like, from the fiscal side and the trade side, to fix this, or we'll raise rates. And at that point, I would think the government's like, yeah, you're right. We'll fix it. So I think normally I don't like selling options for any reason, period. I just don't. That's just me. But on this one, like, yeah, I feel like you're okay there.
Awesome. I love it. All right. So let's get to a topic that's near and dear to my heart and yours as well. Let's talk commodities. Now, we already touched on gold at the beginning. Everyone knows where we stand on that. But I want to just briefly touch on silver. Now, what was interesting to me about silver was, I mean, it looked so bullish, like it was ready to go, and for the first few months of the year. And clearly, there were way too many leverage traders in there, margin too hard. And we got an epic margin call wipeout that was like just this complete washout. And during this period where gold is ripping to all-time new highs, silver ain't making new highs. Like, how do you, in your mind, reconcile this kind of gold versus silver positioning? Are you still bullish here, more neutral? Like, how do you position yourself here on silver?
Yeah, I would call it neutral. So there's a line on like a monthly or quarterly chart that goes back like 15, 20 years at 34.58. That is a monster. So the way I view it is, at some point, and it's rejected price a million times. At some point, that gets taken out, and then it's just on. And for some reason that I cannot explain, and if any listener wants to write in or hit us up on Twitter about this, please. There's a huge like short position in SLV, like, that I cannot wrap my head around, because like any professional would just go use futures. So I just don't understand that position. But regardless, if you get to the point where that 34.58 level finally lets go and you blast to like 36, 37 quickly, because I think you will whenever you finally get through that level, then you have all these SLV shorts that probably have to go running for cover, and you could blast off. So once I feel like that moves there, and every time we kind of start teasing that level, I'll go buy some calls, and they all inevitably, expire worthless. But I'm going to do it every time, because eventually it's going to be a giant move.
A big payday.
Yeah. Until that, I'm basically neutral, and just kind of waiting for that move. Yeah.
Well, I mean, listen, I get it, because I think that all the precious metals should stay bullish for the whole decade. Like, this is like a bigger secular bull market that's going to be intact. But to me, if first of all, what's your take on the idea that silver can march to the beat of its own drum? Or do you generally believe that gold and silver are going to continue to somewhat correlate, even though one will outperform the other in different cycles? But like, if gold is going to go through some sort of, let's say, multi-month consolidation, which is a chance if 3,200 doesn't hold, um, can silver break out in that environment, or do you think that this is really the two are going to be like cousins and they're going to work lockstep here?
I think it can, but I don't. That's not my base case. I mean, if you think about I think the biggest reason gold's doing great is because central banks are such a big buyer. Like the price insensitivity from them is just keeping gold so buoyant, and they're not going to go buy a bunch of silver. Silver depends on industrial demand, things like solar panels. Like, so if you have a global recession because of a trade war, solar panels become a bit of a demand problem. What it needs is that like retail, investment demand to spike to really get going.
Yeah.
And, now retail has all kinds of other fun things to play with, like, betting on the Oscars and buying dog with hats. So I don't know if they'll buy silver the way they did in 2010,
Yeah. Yeah. All right, let's move on. Crude oil. Okay. That was ugly, dude. Like that, we had like a 6-month basing formation anchored in there. And then when things got ugly, the feet kicked out from underneath this, and it just like, it was on a knife's edge at the ledge of a cliff, and it genuinely fell and broke down to the next level. We got down to $55. Is that where the low comes in? Is there more selling to come? It's clearly an ugly downtrend. There's no crayon line I can draw on here to make this bullish. But what are your thoughts here on how this plays out here on crude?
Yeah, I'm bearish. Like I have been all year. I mean, OPEC's is not on your side if you're a bull. The only two things you have going for you possibly are obviously Iran their exports going back to zero would be helpful. And then if U.S. shale, just you call it U.S. oil production, actually does start to roll over, like that would be a big deal. And it looks like that is possibly happening. So that would mean, yeah, maybe the bottom's in, or at least you're not going below, kind of 55 for any duration. But it seems like our negotiations with Iran aren't going that bad. So let's say we cut a deal with them in the next 3 months. Well, now all of a sudden you're taking them off the board as a bullish catalyst. And then as long as OPEC keeps doing what they're doing, I would think you could wash out even to a 4 handle, like being in the 40 range. Now, if you get in the 40s, that's where you go, 2 years out or whatever, and you buy some. Like I think at that point, because then U.S. production really, really will roll over. I find it hard to be bullish. Now, if you get back up to that like recapture that floor that you highlighted a minute ago, that 67, 66, 68 floor, if you can recapture that, I think it makes sense to just buy it with that stop below it and see what happens. But
yeah,
when I look at the fundamentals, I'm bearish. I'm looking for this sort of flag to break and get short again.
There's that old technical saying that what was previously support now acts as overhead resistance, and so it really at this point would need to clear these levels to really kind of depict a change in trend. Otherwise, looking for this to roll over and continue in the prevailing trend is the very basics of technical analysis. So
speaking of that is a real truism. Like the support becoming resistance that becomes support. Like that, if you look at charts every day, you realize like that's not some like hokey pokey technical analysis stuff. That is just real.
Yeah, I agree. It's a very simple rule to have, and it helps you. Because a lot of us traders, what we do is we're very good at lying to ourselves. We basically create an opinion and a bias, and then we see on the charts whatever we want to confirm what we want to see, right? And there's certain things that you can use as checkpoints in your analysis that kind of calls your own bullshit. which is, it's like, is it making lower highs and lower lows? Is it below its moving averages? Is what was previously support acting as resistance? Like, there's certain checklist things where you could call yourself out and say, I'm lying to myself. I gotta just flatten this and wait for the trends to change before I go in.
Yeah, and I love what you just said there. I'm gonna foot stomp that for a sec. That you have to have stuff in place to call your own bullshit. Like I have this pile of books right behind me about
Yeah.
all about global trade in the 1930s. I'm gonna read them all. They're gonna help me understand trade. But like just finding my own bullshit in my own process and my own thinking is way more important than everything I'm gonna learn in those books. It's like it matters more than anything.
Absolutely. Absolutely. All right, let's keep. By the way, very quickly, do you have a different opinion in any way on the energy stocks, or the same brutal charts, the same opinion, the same trends, same everything correlate?
I think if you're more long term than holding like an Exxon or Suncor and stuff, totally fine. Like I think they're great companies. They're going to make money even in the 50s. Like I'm fine with long-term investors not flinching on that stuff. Now, as a trader, am I trying to go jump in there and buy like energy stocks? No. But if I was long-term and I had some of that stuff, I wouldn't be worried about this.
All right. Okay. So let's just touch on copper. I like, obviously
no idea.
Yeah, I would, thank you. I was about to say I have no idea. If you have no idea, we can go on. But like, like, it was a crazy trade. Like, Kevin and I featured a couple times on the show where we were talking about just the difference between the U.S. copper prices versus LME out in London, and just how clearly, maybe driven by the tariff news, there was some sort of front running that drove the U.S. copper prices higher. But just the sheer volatility in this down and up is insane. And I don't know whether to be bullish or bearish on this. Like, it seems to be at a point where I'm just going to leave it alone for a while. Do you have a little more conviction in me?
I do not. It's in my too hard pile. There's days where I think the news flow is good for it and it's down 3%. There's days I think the news flow is bad for it and it's up 4%. So like too hard pile.
There you go. All right. Let's go to the not so hard pile, and let's get into the grain markets, bud. And now I know we were talking before we started recording, and you wanted to touch on these. Let's just go through the grains one at a time, and some of the other charts you wanted. Now, first of all, probably the most bearish one of the grains has got to be wheat, and it kind of failed at its retracement zone, couldn't hold above the 50-day moving average. It's stuck sort of in the mud. What's your thoughts here on the wheat markets before we go on to the other ones?
Yeah, I think wheat looks like crap and I'm long.
All right.
If you actually go out, I think it's like the November or December contract or whatever, and on it's like literally at the lows or right next to them. So for me, it was like, whatever, I'll put this on with a tight stop because who knows what happens. It mostly because I'm essentially bullish on every other ag, and I was like, well, why not buy wheat too? Because if all this other stuff runs, who knows? There you go.
Yeah. So this is your December contract. So the chart looks like shit. There's no other way to put it.
Yeah, like, it looks terrible to long. Yep.
It's along a major support line, but yeah, exactly. Like, you at this point need this thing to double bottom here, get back above that 50-day to show. Hope it works out for you, but
tight stop. Who cares?
Exactly. But let's talk about a few of these others, because corn has been behaving far better in general than wheat. This little retracement right to the 50 days, actually perfect. Tactical places where I love to buy shit. And so this is an interesting, oh, there you go. Like, and so we're at an interesting moment. So I get you when you said you bought it, so you're clearly bullish. What are your thoughts here on this?
Yeah. So same thing. Like I missed the breakout, which made me sad. But then when we came back out to retest it, it was like, oh yeah, well, I'm taking that. And real quick, I'll give my 3 bullet points on why I like ags. One, I like the charts, but if the dollar stays weak, even relatively weak, it's going to help them because it helps them compete globally with selling their products. Strong dollar's been really tough on them. Weather, it looks like in the U.S. ag belt, we're going to have a hot, dry summer as of now, would be helpful. And then when it comes to the trade war, like we actually don't have a bunch of fancy manufactured products to sell people. So we're probably going to shove nat gas and farm products down people's throats. So my guess is every little trade deal is like, yeah, fine, we'll buy a little bit more soybeans or corn or whatever. And I think that could be bullish. So like that, those are the reasons my attention got turned to these markets. But yeah. I love corn here, but if we go dip back below that, the 50-day by much, like then that changes things.
Yeah. Well, I mean, here I'm just going to put it on a weekly chart to really go back and to kind of highlight that we went through a 2-year bear market. Like we've gone through a difficult period where we've gone back to levels where where corn was stuck for a half a decade, right? When we got down into those trade ranges. And on a weekly chart, this thing is just showing signs of potentially breaking out. You throw a trend line like this, you're basically in a situation where like this could be the start of a move. And like while we can never talk about uncertainties, but this is a trade worth taking. Like this is exactly the type of a setup where you've got potential opportunities. Another one that's interesting is the soybean futures. They came in. You're seeing it retest a major support line that's established for almost a year, 9 months or so, where you had like a strong basing formation down along the bottom. And we're now approaching the top of the trade range. And we're going to need a drum roll to find out whether this thing can actually clear and break out to a new high. Clearly, you're in your bullish theme, but any thoughts here?
Yeah, I mean, I think we are going to break out. And the beauty of this one is everyone knows soybeans are going to be the biggest trade war victim. And I think they're going to be the biggest trade war winner because every trade deal is going to be like, fine, we'll buy a couple bushels of soybeans. And then the weather might help out. Like it just, everyone hates it. And there's nothing better than something that's about to break out of a big range that everyone hates. It's perfect.
All right. So let's talk about the one that I don't track, but you brought it up, and that's the soybean oil futures. And I obviously see the merits in this chart. Now, I don't know anything about soybean oil futures, so I'm going to let you just do the talking here, bud.
Yeah, well, who cares? I'll trade number 2 pencil futures. So
I do the block cheese futures personally.
Yeah. So yeah, get that class 3 milk or whatever it's called. Like I'm in for all of it. So I love the chart, and like I said, I already love soybeans. Now, soybean oil and meal tend to do the opposite, and I forget even how all that stuff works. I just know I love the chart, and I like soybeans to begin with. So and in the chart, even to me, looks better than.
This is a beautiful chart.
Right now, today's candle is looking a little crappy, but you're still above that range, so maybe it's just a nice retest.
But you know what? Like to me, this is an extended accumulation price level, right? Like it stopped making lower lows. It is basing, creating a strong base at a price point, and breaking out of the trade range. These are all the things that technicians love to observe, right? When is the price trend changing? Soybean hasn't done this yet. But you clearly are seeing it in the soybean oil futures. So definitely a nice breakout here on the upside. The other one you were mentioning is you wanted to talk here about cotton. So what are your thoughts here on the cotton futures?
Yeah, I've been waiting for this to break out for what feels like my whole life. And I took one stab at it. At some point last year, I took a stab. And then early this year, I was like, I'm just going to buy some calls because I can't trust it yet. But then this week is finally kind of broke out of the sloping downtrend line. It still has a lot of work to do on that just pure horizontal like axis, but at least the diagonal downtrend line and the moving average stuff's kind of out of the way. Same thing. Like, so trade war starts, China stops buying our cotton, becomes a problem. The FX headwind's been a big deal because everyone looks at ours and then they look at like Brazil's that are like with every ag and they're like, well, we'll take Brazil's because their currency's so cheap. getting the dollar back down and getting the Brazil to stabilize. And then again, like everyone's probably going to, if you do 90 trade deals in 90 days, I bet 30 of those people have to buy some cotton. So,
oh, there you go. You know what? It's definitely been an ugly downtrend. It did the classic turtle head formation along the low, created a solid base and trying to break out. It's certainly breaking above this crayon line. So it's worth paying attention to see whether this is the beginning. Let's just touch on a couple other things. Obviously, cocoa futures have kind of took a beautiful bull run, gave it all back in a classic Eiffel Tower formation, and created a base back above the 50-day moving average, rolling up. Do you have any trades here? Are you watching this?
Watching it, no trade at the moment. Probably the best call I've ever made in my life was Coco like three years ago, and then I barely made money on it because I got out way too early. But you can make a very clear horizontal line here. It goes back to February. If we like really get above that, then I get a little excited. Every time Coco tries to fall, you get news out of West Africa where the farmers like actually everything's still shit, and then it picks back up. So and I think it stays that way. But speaking of going back to Brazil, they're planting a ton of cocoa trees. They've never really been in the cocoa game, and they're getting into it. But it's one of those crops where it takes like years for it to start bearing fruit. So as to put a pin in this for people for years from now, it's going to be an amazing short one of these days. Whenever all those new trees come online. But yeah, I am watching for the breakout here. And if you look at coffee, it's already kind of breaking out.
Oh yeah, that's. I was going to get to coffee, but since you mentioned, I'll do it now. But this is to me like a classic retracement. This is it came right down into the 50% retracement. This looks like the chart of Argentina, to be honest. Like if you look at the way that it kind of is trading, but this pullback breakout, like the American breakfaster is going to be pissed because this thing looks like this has got another leg to go on the upside. You're in this, or you're just watching what's next?
Not in it now, but on a decent enough little pullback here. It doesn't take much. I will probably be in it. I just want to be able to keep a tighter stop, so I want it to come back a little bit more.
Yeah. Well, the last thing, of course, is sugar, and this has all been an ugly, painful, long, dragged out chart. Do you think there's any room for this to turn, or is this just a leave it alone chart?
For me, not that interested. But if you go back to my wheat view, like it's so close to the bottom, there's a part of me that just wants to buy it and put a stop at a new low because it's going to be tight. We're trying to put in this quadruple bottom or whatever here. Like who knows? Maybe we can. But yeah, I mean the chart's terrible.
All right, Chase, buddy. Before we wrap up the show, what did I not cover? Is there something that we need to look at that you wanted to talk about that we should?
Maybe just jump on like Mosaic or one of the fertilizer companies. So a lot of them are trying to break out. So like we don't have to look at more than Mosaic, but you can see it's not just the ag futures, but some of the ag adjacent equities are starting to perk up as well. And I'm finding not that many people are focused on this, which
nobody. Oh, come on, nobody. They've been left for dead.
Yep.
You're not going to find a single retail guy talking about this shit. Guaranteed.
Perfect.
The one that's interesting is Intrepid Potash because it didn't waste any time. Yeah, didn't waste any time breaking to a higher high. This thing went through a bloodbath. First of all, it had no business being at 120. It was squeezed up there. So it's not like you want to anchor off of that as a realistic upside target. But this thing was left for dead for 2 entire years. It literally just stuck in that thing. And we're now actually seeing some real constructive price action. I don't like to buy rips. I buy dips. So this thing would have to pull back for me. But this is one that's been getting a lot of attention here over the last little bit. All right. Any last one you want to touch on?
Nope, that's it. I think we covered a lot of ground. That was good.
Yeah. No, listen, that's awesome. Like, but listen, before I let you go and we get into the after show, just why don't you tell all our listeners, about the show that you're doing, where people can find it, and two, where they can find you and follow your stuff.
Yeah, so there's a lot of places these days, but you can go to pinecomacro.com. That's kind of the easiest way to find a lot of things. I have a couple Substacks. I have other research that's separate from the Substack, so it gets a little confusing. But one of them is kind of what we touched on a lot that's new. I call it the passport, PMR passport, and that is it's just country ETF focused letter that I'm doing, and that one's a blast. I think that's going to be more and more important in the future as the U.S. may finally be done sucking in all the world's capital every year. And then I work at Bulwark Capital, so you can check out Bulwark Capital. Easy to find our website, and there we do a daily podcast called Know Your Risk Podcast, and you can find that literally anywhere. And then I have my own podcast, Tailor Made Macro, which I do approximately twice a year at the moment. So eventually I'll speed that one back up. I finally finished college next month, so I hope to do more of those shows. And Kevin was on there. That was a great episode.
Oh, there you go. Once every 2 years, you bring Kevin on. There you go. I like that. So anyway, thanks for all the listeners for tuning in. You know what, Kevin is going to be missing in action for a couple of weeks. He didn't quit the show. He's literally stuck in this jury duty, and so you're going to have to just put up with me. I know it's awful, but we'll make it through, and at some point Kevin will reemerge from all of this. But so anyway, thanks everyone for tuning into the show, and we'll all catch you in future episodes. So stick around for the after show. All right, Danny. Let's start off by rating oh, there you go. It's a great beer. It's a great beer. This is actually a solid IPA. I'm gonna give it a higher score. I'm gonna give it an 8.2.
I don't think I've ever seen you give an 8.2.
Well, first of all, I'm categorically putting it into the IPAs that I typically drink. So like I'm rating an IPA, and this is an IPA that I would think that listeners should try if they have it. I guess it was the creamy head, wasn't it? Let's be honest. All right. So
sorry.
Yeah. No, I like it. Oh, it's anyway. So finally, but Chase, you might not know, but Danny also resides in this beautiful country out here in Portugal. So we're both finally enjoying some much needed summer weather. It's gotten up to like 25 degrees. I've been surfing through all the weather, but
nice.
That's at this point finally some good party weather, and then you can put on the shorts and stuff like that. How's the weather out there on the West Coast for you?
So, spring is basically just more winter here in the Pacific Northwest, but we're finally like hitting the 70s and full sun days, and because in the summer here it's sunny literally every day, and we'll be 70s and 80s every day. So the summer's here perfect, and it's finally starting to show up. I got out on my jet ski last Friday and had a good time. So finally getting there.
Absolutely. No, like Danny, what's up with you? What are you up to nowadays?
Well, currently I'm hanging out at the beach. That's a bit cliche, but I am I'm just hanging out at the beach, and then the amazing ability to be able to record a podcast at the same time, and then
I love it.
And then I'm really enjoying the weather that's come back, and to be honest, cooking outside is a big thing for me, so I'll be doing a lot more.
That's awesome.
So speaking of like Spain, Portugal, every time I look into like digital nomad visas and stuff like that, it always pops up as like, oh, this is basically where you want to go. So you never know. I may be stakes and heading out there someday.
Dude, highly recommend it. It's a fabulous place to be. It sits under the radar. It's like a lot of people will come here on a tourist trip, but it's not that popular from a perspective of moving here, at least not in the bigger circles. Like obviously I know a lot of the nomads that are here, and for those that know the little kind of advantages certainly are rushing in here. But beautiful place to be out here, and yeah, it's great. All right. With that said, guys, I think we should give it a wrap. Listen, Chase, buddy, I really appreciate you stepping in short notice, because we only found out like on Tuesday and Wednesday that Kevin was in this jam. And so the fact that you were able to pinch hit on a short notice, I fucking love talking charts with you. It's we see things often similarly. It's awesome. So thanks so much for coming on, buddy.
Yeah, you bet. I'm literally honored to be, kind of on one of the first off the bench. Anytime Kev hits a snag, it means a lot to me. So yeah, I really appreciate it, and I always enjoy it too.
All right. So let's call it a wrap. Thanks everyone for tuning in, and we'll catch you in the next episode. Cheers, everyone.